Navigating risk. The significance of credit default swaps, CDs, in assessing credit risk in fixed income investments. In the intricate world of fixed income investments, where the ebb and flow of credit risk can sway financial landscapes, credit default swaps, CDs, emerge as powerful instruments that offer investors a nuanced lens through which to evaluate and manage risk. As guardians of capital seek to optimize their portfolios, understanding the significance of CDs becomes paramount in navigating the complex terrain of credit risk within the fixed income market. Demystifying credit default swaps, CDs, ***. At its core, a credit default swap is a financial derivative that enables investors to hedge or speculate on the creditworthiness of a particular bond or a basket of bonds. In simpler terms, a CD serves as a form of insurance against the default of a borrower. If the underlying bond defaults, the seller of the CDs compensates the buyer for the loss incurred, mirroring the bond's face value. Evaluating credit risk through CDs pricing, ***. The significance of credit default swaps lies in their ability to act as barometers of credit risk. The pricing of CDs reflects market participants' collective assessment of the likelihood of a borrower defaulting on its debt obligations. A higher CDs premium implies a perceived increase in credit risk, signaling to investors that the market anticipates a higher probability of default. Consider a scenario where two companies, Company A and Company B, issue similar bonds. If the CDs premium for Company A is significantly higher than that of Company B, it suggests that market participants view Company A as riskier, requiring a higher premium for protection against potential default. This divergence in CDs pricing provides valuable insights for investors seeking to gauge the relative credit risk of different issuers within their fixed income portfolios. Hedging and risk mitigation with CDs, ***. One of the primary functions of credit default swaps is risk mitigation. Investors can use CDs to hedge their fixed income holdings, providing a layer of protection against adverse credit events. For example, if an investor holds a portfolio of corporate bonds and wishes to safeguard against the risk of default, they can purchase CDs contracts on the bonds in their portfolio. In the event of a default, the CD's payouts can offset the losses incurred on the underlying bonds. This risk mitigation strategy is particularly valuable during periods of economic uncertainty or when specific sectors face headwinds. By strategically deploying CDs, investors can tailor their risk exposure, enhancing the resilience of their fixed income portfolios against the unpredictability inherent in credit markets. Credit default swaps as market sentiment indicators, ***. Beyond their role in risk mitigation, credit default swaps also serve as insightful indicators of market sentiment. A surge in CDs spreads, indicating an uptick in credit risk, can signal broader economic concerns, systemic issues, or sector-specific challenges. Conversely, a decline in CDs spreads may suggest improving confidence in the creditworthiness of issuers. Consider the aftermath of the financial crisis when CDs spreads across various sectors widen, reflecting heightened concerns about the stability of financial markets. Investors and analysts keenly monitor these spreads as they navigate the treacherous waters of market sentiment. Using the signals provided by CDs pricing to make informed decisions about portfolio adjustments and risk exposures. CDs and corporate bond investing, ***. In the realm of corporate bond investing, credit default swaps play a pivotal role in shaping investment strategies. Investors can use CDs pricing to identify mispricings in the credit market, uncovering opportunities for alpha generation. For instance, if the CD's premium for a particular corporate bond is higher than warranted by the underlying credit risk. Astute investors may view this as a buying opportunity, expecting the CD's spread to narrow over time. Conversely, a widening CD's spread may prompt investors to reassess their exposure to a specific issuer, especially if it signals a deteriorating credit profile. The ability to incorporate CD's analysis into the decision-making process empowers investors to navigate the dynamic landscape of corporate bonds. With a more comprehensive understanding of the underlying credit risk. Asterisk the role of CDS in sovereign debt analysis, asterisk. Credit default swaps extend their influence beyond corporate bonds into the realm of sovereign debt. Governments and investors alike use CDs to manage and assess the credit risk associated with sovereign bonds. In times of economic turmoil or geopolitical uncertainty, the pricing of CDs on sovereign debt can serve as an early warning system, providing insights into the perceived creditworthiness of nations. During a period of heightened geopolitical tension, for instance, the CD spreads on sovereign bonds of a particular country may widen, reflecting concerns about the government's ability to meet its debt obligations. This information becomes invaluable for global investors as they adjust their portfolios in response to changing risk dynamics associated with sovereign debt. Challenges and controversies surrounding CDs, asterisk. While credit default swaps offer a wealth of information and risk management capabilities, they are not without controversy. Critics argue that the use of CDs can amplify market volatility and contribute to systemic risk. The notorious role of CDs during the 2008 financial crisis, where they were implicated in the downfall of major financial institutions, underscores the need for vigilance in their application. Additionally, concerns about speculative trading and market manipulation have led to regulatory scrutiny and efforts to enhance transparency in the CDs market. Investors must remain cognizant of these challenges and exercise due diligence when incorporating CDs into their investment strategies. Conclusion. Asterisk. In the intricate tapestry of fixed income investments, credit default swaps emerge as indispensable tools, offering investors a multifaceted approach to understanding and managing credit risk. From serving as indicators of market sentiment to providing avenues for risk mitigation and alpha generation, the significance of CDs extends across various dimensions of the financial landscape. As investors navigate the ever-evolving world of fixed income securities, a nuanced understanding of credit default swaps empowers them to make informed decisions, ensuring resilience and adaptability in the face of dynamic credit market conditions.